Now, the investment landscape has been shaped by quantitative easing since the year 2008. Duggan Matthews, investment professional at Marriott, joins us now for more on the line. Duggan, coming back to quantitative easing, it has taken a bit of tapering, that's the word that we use there, but quite clearly this return back to normality is a bit of a painful process for emerging markets.
Yeah, it looks like that. Certainly the last 5 years, as you mentioned, has been shaped by quantitative easing. That unusual form of monetary policy in the first world has had a massive impact of the valuations of bonds, and not only in developed markets but also in emerging markets like South Africa. Cash interest rates have also been at extremely low levels. So it has been a very unusual interest rate environment over the last 5 years, with yields well below historic averages. So I don't think it's completely unsurprising that we should expect, as quantitative easing is tapered or withdrawn, and as interest rates start to begin rising in 2015, that we start getting back to a more normal interest rate environment. It's probably going to be a gradual process. But I think going forward we could see opportunities in the bond market to get a decent income yield from those investments.
With quantitative easing, quite clearly that debt that's been created there, who might pick up the ball?
I think that with quantitative easing has significant implications for emerging markets. I think investors need to recognize that as quantitative easing is being withdrawn in first world economies, it's a signal of a strengthening economic environment in those regions and an improving outlook. So it's a good thing for developed markets. However, it has very negative implications for emerging markets. It will reduce the amount of foreign capital that has been washing into emerging markets for the past 5 years, which is going to put upward pressure on the exchange rate, which obviously puts upward pressure on inflation. Hence, our interest rates in South Africa and other emerging markets are having to begin increasing. And we've also seen bond yields rise as foreigners have reduced their ownership of that asset class. Those factors are going to put severe pressure on emerging market economies, specifically or especially those with large current account deficits like South Africa. So whereas economic growth prospects are on the up in first world markets, the repercussions of a slowdown in quantitative easing is certainly being felt in emerging markets like South Africa.
You know the investment cycles, and it's pretty clear when interest rates start rising, watch out equities, watch out property. Given the scenario that you've just painted for us, are you of the opinion that the bull market might be coming to an end?
I think so. I think that the consumer in South Africa is certainly under pressure and has been extending themselves over the last 3 to 4 years. If you just look at consumer confidence, it's currently sitting at a decade low, and that coincides with a time when interest rates are at a 4-decade low. So that's very unusual. And as Jill Marcus has indicated, we are in the beginning of an interest rate hiking cycle. As rates begin to rise, it is going to put pressure on the South African consumer, which is the biggest driver of economic growth in South Africa, and undoubtedly that is going to have an impact on the profitability of companies in South Africa. Their earnings growth prospects are going to come under pressure. So investors are going to need to be selective with regards to which equities they want exposure to ensure an acceptable real return over the next 5 years.
Does that mean looking offshore, Duggan?
We think so. As I've mentioned, economic prospects are improving there, hence the tapering and hence the talk of interest rates rising in 2015. So the foundation for a sustainable economic recovery is there, and the outlook is improving all the time. And the valuations of many first world listed companies we feel are offering good value to investors now. You're seeing yields on blue chip multinationals in the region of 3 to 4% with secure earnings growth prospects, and we think a good investment opportunity for investors to consider going forward.
We have seen the rand improving lately. I mean, we're at a few months highs at the moment.
Yeah.
Is this something that you would expect to reverse itself? Because clearly if you're going to invest abroad, you'd like to get a bit of a kicker as a rand hedge.
It's going to be, I feel that it's going to be difficult for the rand to get much stronger or to maintain much strength, because we are running a current account deficit at the moment. We do need to be more competitive from an export perspective. So in order for South Africa to, for the economic environment in South Africa to improve, we need to be able to compete globally, especially our manufacturing sector. At much stronger levels than these, it's proved difficult for that sector of the economy. So we don't think there's much in favor of the rand strengthening appreciably from these levels. And we think, in fact, what perhaps might be best for the South African economy is for the rand to remain weak and stable for a period of time, to give the manufacturing side of our economy an opportunity to take advantage of that environment.
Well, Duggan, we have to leave it there for today. Thank you so much for your time.